Hello everyone, Dividend Enjoyer here, and today I kind of want to talk about a stock that I'm really watching very closely in case it dips lower and hoping that I can add more of a position in. And this, of course, is Waste Management, ticker symbol WM. And my reasoning for watching this stock is that I think it's going to be worth a lot more in the future, obviously, just because they're able to organically grow pretty reliably. And they also reliably do a lot of mergers and acquisitions that make sense to add more landfills and just areas where they can bring in more free cash flow over time. And I think that the business is very strong and reliable in the long term. And I do want to add more to this position, even if it's at a premium. But I just kind of want to talk about why I'm looking at adding more of this now instead of trying to add more tech stocks that I've been traditionally trying to add. So as you guys know, I've been really just making a lot of videos talking about a lot of the tech stocks when there was so much uncertainty and prices were so good. And I actually made a video about Meta when I bought one share below $500. And as of recording this video, Meta closed above $656. So it was a pretty good gain for about 3 weeks. And obviously, Meta is one of the more volatile stocks. But I can also highlight me talking about Amazon, which I'm now up about 4% on when I was down an extreme amount. And I kind of talked about that as well. American Express as well. I was really trying to add more positions to my American Express position or add more shares to my American Express position, buying around the 260 mark. I even got one share at 231.81, which is obviously extremely low. That's already up about 30% from where I bought it. And really just, I kind of think that we're seeing a transition now away from tech or away from defensive stocks like Waste Management, into tech stocks. And I kind of think that you want to be very much of a contrarian, and I really kind of like Waste Management more than the tech stocks, just personally, because I think that Waste Management is going to be able to grow despite the economic conditions that are there. So I'm really hoping that Waste Management dips below 220 because I still think that that's probably a premium to be buying Waste Management, but I think it's going to be very difficult to get Waste Management at a very bargain price just because of the nature of the business that it is. I also kind of thought about Vici as well. I've kind of always put this on my channel in my weekly kind of portfolio reviews that if Vici goes below 30, that's a no-brainer to me, and I will be buying hand over fist. I have been saving up my cash to invest lately and trying to just get the correct opportunity to be able to deploy some serious capital on a really just no-brainer position that's going to grow my portfolio in the long term. But I think that Waste Management is one of those companies that if you're willing to hold it for at least 3 years, you're probably going to be making money on it no matter when you buy, even if it's at the high point. And I don't think we're at the high point necessarily. I think that this is a really fair value for Waste Management where we're seeing it now. But I think that below 220, if you can get it at 215, that's an amazing deal in my opinion. But 220 or below, I really think is a very fair, probably you're likely going to be making money on Waste Management. I think it's relatively cheap compared to historically where it does trade at, just because it is such high quality, even though it grows very slowly and very reliably. So if Waste Management goes below 220, I will probably be adding more shares, but until then, I'm probably just going to be sitting on the sideline with cash, watching Vici, watching Waste Management, but mainly watching Waste Management because I really regret not having a bigger position in Waste Management when it was trading as low as it was and when tech stocks were trading as high as they were. And I think that it was very smart of me to get into tech during the time when I did because I think it was a better opportunity than where Waste Management is right now. If that makes sense, I think that tech is going to continue to be able to grow. I think that it has a lot of monopolistic advantages, especially with the tech companies that I'm in. And I'm kind of watching defensive stocks because I think if you didn't get into tech, I think it is going to continue to run up, but I don't think you're going to see the same types of deals that we were getting before. And I think that's a reason to kind of put some cash to the side and wait for another good opportunity, because you want to be patient when you're buying, because it's very important to get good prices and good value. Another thing I'm really considering adding to is Energy Transfer as well. Although I do have a significant portion of my portfolios in Energy Transfer, it's currently my biggest position. But I think that energy as a whole is going to be more valued in the future. I think that there's going to be a higher demand for it. And if you believe that there's a higher demand for energy consumption, especially in North America, Energy Transfer is probably the right stock for you. But I also think that some other energy companies are also pretty good buys here too. But overall, I think that the really big opportunity for this year was the tech stocks at the lows that they were trading at. And I think that a lot of people probably missed the boat because they were either afraid or they were sitting on the sidelines for too long. I think that it can definitely work against you if you're sitting with a big cash pile and you're very afraid and you're very unsure. My reasoning for being very sure about these tech companies is that they had every advantage that they could possibly have. They're very monopolistic, at least the ones I bought. They have reliable, good free cash flow. And in the long term, I thought that the business would still survive. And I had pros and cons of what the tariffs would kind of look like. I thought it was more likely that the tariffs would be temporary, but I still thought that it was really kind of up in the air. But even with my worst case scenario, I still thought that a lot of these tech companies that I bought into would do all right. And I think that they're still probably below the fair value, below the value that they're practically worth if you just look at them from the standpoint of what they bring to society and the kind of cash that they generate. I think that they're really amazing companies that are good long-term holds and even maybe buys here. But I really think I made the right play on that. And I think that the right play now is to get into the more defensive stocks for the long term, because a lot of Wall Street's kind of rotating out of defensive and going back into tech. And the big money is what really moves the market. And the big money is not always the intelligent money. The big money is definitely not the patient money usually. And I think that there's a lot of opportunities in a lot of just very defensive stocks. Consumer staples, I think, are going to be good. I think it might be worth looking into Walmart. I also want to look at Take-Two Interactive just because I really enjoyed the fact that they were delaying Grand Theft Auto 6 to make it as good of a release as they possibly can, because I think that it would have been very problematic if a game with this much hype didn't live up to it. And Rockstar knows exactly what they're doing. They're not going to release a product that is poor. And I also think that you have to milk the GTA 5 cow for as long as you can. I think that you have to make as much money from GTA 5 as you can and really produce amazing products that meet the Rockstar standard. So those are kind of some of the companies that are kind of up in the air for me that I'm really considering. Waste Management is really my number one because I can see myself holding that company for literally the rest of my life. And I think that I might even buy a little bit now just because I think that it's a very strong company that I'm willing to hold for the long term. And I think that there is going to be some growth in the future. But I really just want to say that I think the big opportunities have probably passed us. I mean, the big opportunities for making a lot of money have probably already happened this year with the tariffs. But I also think that there's the very likely possibility that there's going to be more volatility and more opportunities to sell out of something that's very overvalued if you want to get out, and some opportunities that the market is going to basically whiplash both ways. So there might be some good opportunities to buy back in if the tariff talks with China don't go the way people expect them to, if the Fed does something that Wall Street doesn't like. There could be a million different things that could happen, a global pandemic. various things that could make the market go back lower, but I don't think that we're going to be able to really see the kind of deals that we had at the beginning of this year. And I'm very happy that I really stuck to my guns and went all in, because I was down at one point during this year, and I think you can go back in the videos and see maybe it wasn't this low, because this is just what I remember the worst of the worst for this year being, that I was down about $2,000. And now looking at my account, I believe I'm currently up a little over $500 on an unrealized basis. And that doesn't include $179 that I've earned year to date from dividends. So I really think that it's very smart to go against the grain in a lot of cases when it doesn't logically make sense to you. And it doesn't make sense to me to want to add more tech, because I think that I've really overweight tech right now in my portfolio. I want to add some more really just very defensive, solid dividend companies, but also solid dividend compound annual growth companies that are going to give me some decent passive income. I do think that eventually I'm going to, instead of just reinvesting the dividends into the same company that pays them, I'm going to just take the cash and then evaluate what I want to put that cash into. But I don't really feel like it's a significant enough amount of money to really care enough about it, if that makes sense. I know that sounds kind of crazy when the portfolio at this point, as a recording, is over $30,000, but it's only generating about $1,100 a year. So I'd rather just have it reinvest into those things, so that I'm not sitting there with $4 or $5 from a particular company wondering, where can I actually put this to reinvest it? So maybe I have to manually go in and put the companies that pay a higher dividend, like Vici, to pay me just in cash, and then the ones that pay a lower dividend to reinvest, which could be very smart. And I know that Chase allows that as a broker, so maybe I have to explore that. But this is all just to kind of say that I think that the tech opportunity has really passed us, and now we should be looking to get into more defensive stocks that in the long term are going to do very well, very consistently, because you kind of want to take the risk out of it. Now, this isn't to say that I'm going back on what I said before, where I'm kind of sitting on the sideline right now. I still am very much sitting on the sideline and collecting cash, but I just wanted to let you guys know that for me personally, I'm very much watching the defensive stocks. I'm hoping that they go down more. And if they go down a significant amount, I'm going to be adding more of them to my portfolio, because I think that they are going to be a better value in the long term. And I think that they're kind of insulated from the tariff risks. And I think that the market's being way too optimistic that everything with the tariffs is going to be sunshine and rainbows. I don't think it was going to be as bad as they initially thought when Trump talked about them. I mean, it didn't make any sense. It was just a negotiation tactic. And these are the biggest, most wonderful companies in human existence. So their value should have been higher at the time. And I think Wall Street's kind of realizing that. But this is to say that I think it's very valuable to have companies that are going to consistently perform well and to hold those over the long term, because those types of companies are very valuable to have in your portfolio at all times, because they really insulate you from a lot of risks and they allow you to retain a lot of value very well. This is to say, if you run into a personal situation where you need some of your investment income and you need to sell off a stock, and tech stocks have temporarily crashed, you could go into your waste management stock, sell a little bit of it out, and collect the cash if you really need it. But if you just have tech, if you're overweight something that's a little bit higher risk, higher volatility, and it crashes down and all of a sudden you need the money for a certain event or for a certain thing, it's going to really suck to pull your tech stocks, like when I bought my Meta stock for under 500 and then 3 weeks later it's worth over 650, right? So it makes sense to have very consistent stocks really be kind of the foundation of your portfolio. And I really do believe that, but I think that you also have to kind of play what the market's handing to you. And defensive stocks, in my opinion, were really overvalued because we were in kind of a crisis scenario in the market. And now it's kind of gone the other way, where I think that tech is going to boom and boom and boom, and eventually it's going to bust back down again. And I think that everyone's kind of rotating out of the defensive things because defensive stocks are really there for when there's a big crash in the market, and the big crash already pretty much happened. So a lot of Wall Street people are not very interested in defensive stocks anymore. They want big alpha now. And so it makes the most sense to get very stable, reliable companies right now because I think that they're an amazing thing to build your portfolio with. I think it's an amazing thing to have less risk. And to have companies that are going to really provide you with that stability, usually a good dividend, and have amazing businesses like Waste Management has, like what Walmart has, like what Vici has, something very predictable. Energy Transfer, you're kind of taking on the risk of oil prices and a myriad of different things. Mainly, that's more of a bet on if you think energy demand is going to increase, but I do think it's a good value right here. And those are just kind of my thoughts on what's going on right now. And yeah, that's all just to kind of say, I think that the big opportunity for the year has passed us. I hope you got in. I hope you added some wonderful tech stocks to your portfolio. I think that there will be other opportunities this year, but I think that this was really the biggest one to make the biggest gains in the long term. And yeah, that's pretty much it. Thank you guys for watching. I really appreciate all of your support. I hope that you hit the subscribe button if you made it this far. And I'd love to hear what your guys' thoughts are because that's just kind of what I'm seeing. That's kind of what I'm watching. I'm watching the defensive stocks. And if Waste Management goes below 220, I'll probably add a little bit. And if it goes to 215 or below, I will probably be adding a more significant amount to my portfolio. Thank you for watching again. Hope you enjoyed the video. Have a great rest of your day. Bye.